And all my windows are down too because it's fucking hot. My shirt's literally off as well. The struggles of being a small-time YouTuber. This is my studio. Okie doke, so I'm kind of just copying what I did this time last year, and by that I mean I did a yearly summary video, then a New Year's goals / resolution type of video, even though my New Year's resolution is always just to build on what I achieved in the prior year, and then a stock market outlook. I haven't made an investor-specific video in a while, so I figured I may as well make one now, since I'm already copying what I've done in prior years. So in the last video, my outlook was bearish, in case you couldn't tell from the thumbnail. For anyone who doesn't quite get the concepts involved in the stock market talk, bearish refers to stuff going down in value, while bullish refers to stuff going up in value. Dovish refers to central bankers having a positive outlook on their goals, aka inflation is coming down nicely, meaning they tend to lower interest rates, which means the prices of stocks and real estate generally goes up, and the value of the currency goes down. And hawkish means central bankers have a more negative outlook on their goals, such as inflation isn't coming down much, or there are too many jobs in the economy, / too many people working, / too many people with money, meaning they tend to raise interest rates, which means the prices of stocks and real estate generally goes down. Except for Australia recently, our housing market will go up no matter what. And the value of the local currency goes up. Think of it as hawks and bears have claws. They claw at your money. They claw back the money you have. Bulls go on a bull run, just like your stocks have gone on a run upwards. Doves fly up high in the sky, just like the value of your stocks whenever central bankers lower interest rates / gives a more dovish outlook on the economy, causes your stocks to go up high in the sky in value. So, case in point, I wasn't too confident about the stock market headed into 2023. However, my reasons weren't totally unjustified. Based on what I saw, the economy was headed into a shit show, which did happen. We had banks failing in the States, homelessness spreading. Even here in Australia, we have tent cities around Brisbane. So I figured there would be a correlation between bad stock prices and the economy. However, the stock market is not the economy, which I already knew before 2023 started, but I never realized how decoupled they were from each other. I mentioned this in the 2023 wrap-up video, but good sources of information such as the Maverick of Wall Street, Nobody Special Finance, and Walk the World, to name a few, all had very bearish outlooks. But I distinctly remember a chart the Traveling Trader showed in one of his videos. During the 1980s recession, the stock market actually rallied, despite the fact these were hard economic times. So this really opened my eyes as to how decoupled the stock market is from the economy. Plus, other sources of stock market info such as Options Drops, Stocks Today, My Strategic Forecast, Unco Chartist, and Harmon Trades have consistently said, trade with what the market gives you. Options Drops, Unco Chartist, and Harmon Trades were channels I mentioned I watch consistently in this video, and Stocks Today and My Strategic Forecast are finance channels that I found recently, as mentioned in this video. So these guys always go with the price action and trend. They have no bias one way or the other, which is what I've adopted now. At the time of writing this in late December, it seems the market is just bullish all round, as recently the Federal Reserve's dot plot has shown that no one is expecting any more rate hikes, and some are predicting as many as 3 rate cuts in 2024. Good news for the stock market. However, more bearish channels such as the Maverick of Wall Street, Nobody Special Finance, and Walk the World all say the Fed only cuts if something in the economy breaks, which is not a good sign for the stock market, which is true. If the Fed cuts, then maybe it's because they've destroyed too many banks, since too many banks end up selling their treasuries for a loss which destroys them, so they reverse this by cutting rates. Now that's a super simplified version of why some banks failed in 2023, but there's info on the internet if you want to know more. I gotta try and keep this video on the shorter side. Challenge impossible for me. So anyway, all of this is to say I have a more rosy outlook for the market in 2024, and I'll be putting my money where my mouth is. In my last year's prediction video, I gave more specific predictions such as Aussie inflation will end the year higher than the US. I gave my predictions for what the cash/interest rate would be for both the US and Australian central banks. But I won't do this time since the US market and the Fed dot plot is predicting a few rate cuts next year, but who knows if that'll happen. I mean, I think it will, but I'm not going to predict anything. And here in Australia, our central bank recently contemplated raising rates again, but they didn't. And some banks here are predicting cuts for next year, but who knows? So I'll make no macroeconomic predictions at the moment, since there's way too many variables. In last year's prediction, I also gave a list of stocks that I think would end the year higher, and stocks that would end the year lower. If you saw that video, you'll know I was totally wrong. You could have done the opposite and made good money. I defended myself in that video, but basically my theories weren't unfounded. They had good information backing them, but a lot can happen in 1 year. So to spare myself embarrassment, I won't predict any stocks that will rise or fall in 2024, since who knows what could happen. These videos can be some fun, but at the moment there's just way too many factors to take into account. What I will talk about, however, is where I'm putting my money and what I'm going to do with it for my long-term portfolio. The reason I didn't specifically say these stocks will probably rise in 2024 is because this is long-term. It's beyond 2024. I'm just going to start buying now, since I think there's a good opportunity to buy now, and I have enough of a comfortable cash net for my land/house, so I feel comfortable buying into the market now. So the first stock I'll buy into is VHY, which is an Australian high dividend yield ETF. It basically holds 76 Aussie companies that provide good dividends. The reason I've picked an Australian-specific ETF for dividends is because of the way our tax system works. The long and short of it is, the way Australia's tax system is designed means you pay less on your taxes from dividend payments, as well as receiving the dividend money too. Slowly building this up earlier means you'll have some good passive income flowing in the future, as well as a smaller tax bill, which you wouldn't get in other countries. Some other countries have this franking credit system too, but not many. This will probably be one of the lowest priorities on my list to buy into the coming months, since I doubt the price of this will raise much. Since companies that pay out dividends have hindered price growth, and I would rather get into the US stocks earlier before they rise up first, but that does also mean I receive less in dividend payments until I do fork out more money for this investment. Now we will go over my individual stock picks. Second on my list is DBO, which is an oil ETF. You'll find I'm heavily positioned in oil, but that's because I just see way too many future factors that lead me to believe the price of oil will be much higher than it is now. And obviously, an ETF that tracks the futures of oil will go up as the price of oil goes up. I will mention, however, there is the risk that oil prices don't go up as much in 2024, as countries like America and some African countries are keen to increase oil supply, which suppresses the price. And if they somehow suppress the price of oil long enough, then other sources of energy such as uranium may be able to catch up and replace the use of oil, which would kill all of my trades. Also, if China's economy never recovers, there goes a lot of demand for oil. We also have an election year in the United States in 2024, so the Biden administration will more than likely do everything in their power to keep oil prices down in 2024, which is fine since the intention isn't to make profits from these trades in 2024, it's to start accumulating positions now in order to make profits in the following years. On the other hand, Saudi Arabia is keen to spike oil prices, so they'll do what they can to cause oil prices to spike, as they control Saudi Aramco, aka one of the biggest companies in the world. And the Saudis are super reliant on oil for their revenue, and they're like the main player in OPEC, which in a way controls oil supply. Plus, I don't see how renewable sources of energy will be ready to replace oil in the next 5 years, so in the meantime, we will need oil. And with the supply of oil running out, this also increases the cost as the supply is further reduced. Now, yes, they won't run out of oil for, another 50 years? But this doesn't change the fact that we will need oil, the supply is running out, and the replacements won't be ready anytime soon. I did mention earlier how, if they suppress oil for long enough, then uranium and maybe other sources of energy will catch up. But that's assuming they suppress oil for a lot longer than 5 years. I doubt they will be able to, which is why I'm heavily positioned in oil, or I'm going to be in 2024 and beyond, But there is the risk that, America and Africa and other oil producing countries can suppress the price for long enough for other renewable sources of energy to keep up. But I doubt it. So that's why I'm putting my money where my mouth is by getting into oil stuff now. We can actually dig further into the Earth's core for more oil, but it will become super expensive to do so, at least from what I've seen. Case in point, I believe oil prices will be up in the coming years. However, the US could have a trick up their sleeve to prevent oil prices from rising. As far as I know, there are many permits approved to drill for oil, but oil companies won't do this as it'll hurt their bottom line. But perhaps the government enforces something that forces them to drill. Who knows? I am net bullish on oil, but it's not a guarantee, especially considering how influenced oil is by politics, which is something I can't predict. Plus, recently we've seen Angola leave OPEC. What this means is they will no longer adhere to what OPEC wants them to do, which lately has been cutting oil supply in an attempt to drive up prices. So, instead, Angola will produce whatever amount of oil they want, so this could increase the supply of oil on the market, driving down prices. So who knows, maybe more countries leave OPEC, meaning they can produce as much oil as they want, again driving down prices. There are many factors to take into account when making decisions in the stock market. It is designed to go higher. Simply buying into the market each month is a viable strategy, but there's extra money to be made if you play your cards right. And based on my evidence, oil should be valued more in the near future, which drives up oil-related stocks faster than the market as a whole. The price increase won't last forever, so once I believe oil has almost topped out, I'll shift out of oil and into another sector. Now, what that sector is remains to be seen. It's too early to predict the best sector in 5+ years from now. Maybe it's lithium, maybe it's uranium, maybe it's some sort of new tech thing, maybe it's healthcare. Who knows? Time will tell. Next up, CDE Coeur Mining. To be honest, I only just found this company since they mine precious metals and their stock price was cheap. That's literally it. I was watching some specialist share education video, a channel I mentioned recently, and he was saying something about the potential of precious metals rallying at some point. So check out mining stocks, is what he said. I think he mentioned a specific metal that I can't recall now, but I checked a few mining companies and this one had a really low share price compared to the others. Now yes, generally this means nothing, but it's had highs around $10 before and it was around $2 at the time of first finding it. And since it's not a meme stock, I think it can recapture these highs if the commodities market does well enough. Very simplistic, borderline degenerate analysis, but hey, it's worked so far. But to be honest, if this rallies hard enough, I may just totally sell out of this, since I don't want to be too heavily exposed to commodities, and of all my commodities plays, this one is the weakest link, despite how well it's done recently. Next up, Chevron, another oil-related play. And I picked this because they're doing an enormous share buyback plan. Share buybacks are controversial amongst many stock traders, but basically, the company buys their own shares back from the open market or other investors, which means now there is less supply of shares, which drives up the share price. The share price also goes up because of the high buying volume. So, as Chevron buys back its shares over the coming years, it'll pump up their stock price. The other big oil company you could choose is Occidental Petroleum, but at the time of recording, they don't have a giant share buyback plan, and Berkshire Hathaway has recently invested heavily into them. Now, this is a good thing because Berkshire Hathaway provides a lot of capital for the company, but this also means the share price is more heavily influenced by what Berkshire does. Maybe they decide to sell out, which would have a net negative impact on their share price. To each their own, but I'm more of a fan of Chevron's share buyback plan than I am of Berkshire's involvement in Occidental Petroleum. You could also choose ExxonMobil, but again, I'd be too heavily invested into oil/commodities, and the share buyback plan is just too juicy for me to ignore. Chevron also has experience in Venezuela, which means whenever the country decides it wants more oil production, Chevron is usually the company to come into the country to help with the oil production. And Venezuela has one of the largest oil reserves in the world, might even be the largest. So there's more upside potential for Chevron if Venezuela realizes the potential for their economy. But since the company is in political turmoil, I wouldn't rely on this. Additionally, with Venezuela looking to invade Guyana, there is further political turmoil ahead. One of the primary reasons for this political invasion is oil-related, so Venezuela could become a mass producer of oil if this was to occur, which is good for Chevron since they're most likely the big oil company to be involved in this production. But then again, it could also suppress oil prices as a whole if supply drastically increases. Next is NextEra Energy, another energy play. I won't hold this for long. This is the stock I have the second least confidence in, but I'm in this for now since Click Capital had gone over how undervalued this stock was at the time of him making that video. Maybe it's fairly valued now, but I see more upside as the overall market rallies. And who knows, maybe I ditch another energy company and hold this one instead. But at the time of recording, this will be a stock I'll sell out of once I see we're nearing a top in renewable energy. Next up, MasterCard. With governments around the globe trying to scrap cash, especially here in Australia, more people will be using their credit cards, meaning more merchant fees for MasterCard. One reason I picked MasterCard over Visa is MasterCard is more popular here in Australia, as I can see the difference between which customers pay via MasterCard and which pay via Visa at my office job, meaning MasterCard has more potential upside revenue from the land down under, especially with cash being harder to use here. I'm aware Visa is more popular around the globe, but this hasn't necessarily made much of a difference in their stock price compared to MasterCard, which kinda contradicts my reason for choosing MasterCard over Visa, that being its popularity here in Australia, but my second reason is because Joseph Carlson has gone into depth in MasterCard's company details, and he has good reasons to invest into MasterCard. Good enough for me. There are other comparisons such as travel insurance, but these are individual specific, so this doesn't really play into my decision either way. Now, generally, I'd have my own specific thesis for investing into a particular stock, rather than letting someone else do it for me, such as letting Joseph Carlson swing my decision more towards MasterCard. Because otherwise, I may as well just invest into a managed fund or the S&P 500. You know, instead of learning myself, just let someone else increase the value of my portfolio. However, my thesis is merchant fees from both companies will only rise in the future. Whoever I pick ultimately doesn't matter a whole lot, but I do need to pick one. And I've got a few more reasons to pick MasterCard over Visa, so that's why I picked MasterCard. Not to say investing in Visa is bad, but I've chosen MasterCard. Next up, Costco, good company that sells bulk stuff. Super popular, especially given the rough economic climate many are facing. No matter the economy, Costco should do well. Plus, their CEO recently had an interview in which they were promoting a long-time Costco employee to CEO. Obviously, this wasn't someone working in the store or anything, but it shows Costco is sticking to their culture, meaning they're not going to hire a CEO from another company that will milk the company in the short term for their own benefit, then leave after 5 years, leaving the company a wreck. So this is extra confidence for Costco in the long run. I have a Costco membership myself, not only because they sell heaps of good shit, but it's so I can rizz up the bitches without having to take my shirt off. This is a good, safe defensive stock that also has the potential to have good rallies when the market rises. Next up, AMPY. This is another oil stock. I'm holding this until I see oil peaking out in price. Nasdaq King / King Triple Q went over this. He basically said last time oil rallied, this stock, and another stock I'll mention shortly, rallied hard when the oil price rallied. At the time of learning this info, oil was headed down, so it made for a good buying opportunity. So I'm only holding this until I see oil topping out. Otherwise, I'm too heavily exposed to oil. I am confident in my oil plays, but it'd make more sense to have more money into Chevron than spreading it out across several companies. I'm only going to milk AMPY for the next rally. My longer term oil play is mainly Chevron. Next up, CCJ, a uranium play. Surprise, surprise, another commodity. But uranium is a super efficient source of energy, And lately governments have been waking up and realizing that uranium isn't the deadly toxin they once thought. Just don't build your uranium plants next to the fucking ocean. So uranium is another good play for the future. I foresee uranium being the next big energy source. It's too early to tell anything, but my guess is in 10 years, uranium stocks will be pumping, whilst oil stocks will be running out of gas, no pun intended. So like my oil plays are like 5 to 10 year plays, whereas oil will be one for 10 plus years. I'm just buying now, whilst it's not super expensive. Take those time horizons with a grain of iodized table salt. No one really knows exactly when both sources of energy will have their moments. Next up, CGC, a cannabis stock, another good play for the future as cannabis becomes more accepted and legalized over America. I picked this since it's got good meme stock potential, aka it rises drastically when the market goes up. Plus, it's a cannabis stock. It'll rise as the cannabis sector expands. However, I've had discussions on Twitter with some experts in cannabis stocks, and they've suggested other stocks instead. For now, I will hold CGC and I will sell out once this has had a drastic rally, as I expect to see one next time the market pumps. I mentioned before how I don't like the decisions of others impacting my investment decisions, because it means I'm not learning, but to be honest, my decision is weak compared to these other guys on Twitter, since they've delved extensively into the sector. So in a way, I am learning because these experts have done their homework for me, and now I know better. Like if I watch a TikTok of someone saying, here are my 5 top stock picks, Tesla, Microsoft, Apple, Google, Amazon. I'm not going to buy these since I didn't learn anything. Someone just told me something. And plus any monkey can go into Google and type in top 5 stocks and chances are those are the ones that'll show up. But if I'm thinking, I like this particular sector, such as merchant fees with credit cards or the cannabis sector, but I don't know which stock to choose from. And then I find videos from Joseph Carlson where he delves into the details of one of those companies, or I find a particular Twitter account that delves into the details of several cannabis companies and provides a recommendation from there. That's when I'll buy in based on what someone else says, because I was already interested in that sector from my own learning in the first place. I've just now narrowed it down thanks to the research from others. I hope that makes sense. Like, I don't buy a stock because someone said so, but I will buy a stock if I was already interested in that particular sector and someone with more expertise than me has given their reasons for that stock. Like Joseph Carlson invests in some railway company. He has his own reasons for that, but personally, the railway industry doesn't interest me. Same with Texas Roadhouse, a stock he talks about a lot, but I'm not interested. But he is. That's fine. I didn't buy MasterCard because he said so, otherwise I would have bought Texas Roadhouse too. I didn't consider the other cannabis stocks because someone said so. I considered them because they've provided good reasons to pick those stocks in the sector I was already interested in. Next up, Nine! Another oil stock. Got this idea from Nasdaq King / King Triple Q. This is the other stock I mentioned earlier. Again, I was already interested in the oil sector, but someone with more expertise than me has had their reasons for picking up these companies. I'm going to sell out once I feel oil has topped, but the YouTuber said how Nine tends to rally as oil rallies. Pretty sure he said this can potentially reach $18 if oil plays out the way it should. This is in the coming years, mind you, and Nine was about $2 at the time of making this video. I was already bullish on oil, so this stock was a nice hidden nugget that no other finance channel mentioned. Again, this is why you listen to numerous channels. Go hunting for tidbits. I'm a part-time hunter / hunting is my hobby. I go hunting for juicy tidbits in the stock market. Next up, Tilray, another cannabis stock. This one is commonly talked about by Stocked Up and no one else. Again, hunt for tidbits. And again, another sector I was already interested in / bullish on. I'll slowly buy into this as well as my other cannabis plays that I'll open up soon enough. DraftKings, another stock that Stocked Up talks about a lot, but once again, I was already interested in this sector. It just so happens that people with more expertise than me have a good stock pick in mind. DraftKings is like one of the leading sports gambling companies in the States, and sports gambling is growing over there. Sports betting is shrinking here in Australia. The amount of disclaimers I've seen after sports betting ads is increasing, and the number of ads in general are decreasing.
Introducing Craig the Call-Up King. When there's a late slot to fill at the races, he goes from having nothing on to getting on quickly. That's why he uses Sportsbet's new fast form to find a winner. Track talent? Tick. Striking distance? Absolutely. Oh, that's good form. Fast and easy. What's this? Another ticket? Giddy up. Make spring look easy with Sportsbet.
Chances are you're about to lose. For free and confidential support, call the number on the screen or visit the website.
Today, we celebrate the long-awaited union of Richo's drill and his drill bit. Such a happy occasion, mainly because Richo can finally attack those odd jobs. Richo, do you promise to have and to hold this drill bit forevermore?
I do.
And Damo, do you vow to stop borrowing stuff and not returning it for ages?
I can't commit to that.
Fair enough. Well, I now pronounce you man and complete tool.
Congratulations, fellas. That's a great mate moment. And so's this. Sportsbet's Bet with Mates now comes with chat, so you can share a bet and some banter with Sportsbet.
What are you really gambling with? For free and confidential support, call the number on the screen or visit the website.
There have been other sports gambling stocks popping up in recent times, such as ESPN Bet, but from what I've seen, DraftKings should be a better play, especially with ESPN being owned by Disney. Not a fan. The DraftKings CEO and CFO recently did sell a lot of stock they were holding in the company though. Insiders can sell for many reasons. Maybe they wanted to fund their new super yachts, but maybe they saw something bad coming up. Who knows? But either way, I do like the sports betting scene in the States for years to come. KRBN, this is a carbon credit stock. Very simply, carbon credits are a license to pollute carbon. The idea was, in the future, companies will need to purchase carbon credits from the government in order to continue polluting. So, getting in early seemed like a good play. However, from what I've seen in the past year, it's unlikely this thing will even play out, so maybe this is a lost cause, but I'll continue to buy in if I see the potential of this actually happening. I'm not going to buy in much anytime soon, unless I start seeing the regulatory environment heading in that direction. Next up, Palantir, an AI stock that sells a lot of stuff to the government, or they have government contracts anyway. Generally, companies with government contracts are a good idea. Recently, their contract with the US military got renewed, but at a lesser amount than last time, which isn't ideal, but I reckon the AI capabilities of this stock are good for the future. But I'd be lying if I said I wasn't nervous about this pick. There are two primary reasons. One, Tom Nash and Cathie Wood are fans of this stock. I don't mean to talk down on people who've actually worked in the finance field or are currently working in it, since that's rich coming from a guy who hasn't worked in that field. It'd be like someone who doesn't even go to the gym criticizing my training routine. But their track record is quite bad. So generally these guys jinx stocks they touch. And two, the CEO is a nutcase. He's had a sort of dodgy past. Now, unfortunately, I cannot remember exactly what he did, since this did happen a while ago. And as you can imagine, listening to the stock market each day, obviously I'm going to forget some things. And I can't find any news relating to it, but I swear it had something to do with him selling out of heaps of his own company's stock, not taking stuff seriously. I don't know, something along those lines. Now, feel free to totally dismiss these claims, since I can't back it up, but I distinctly remember some controversy relating to Alex Karp. But that's another reason I'm not super bullish on Palantir. The CEO has some red flags. The difference between Elon and Alex is Elon's company/companies are proven and aren't up and coming, whereas Palantir kinda is up and coming. It's not really established that much as of yet, but if I had to choose, I'd lean towards Palantir being a good stock for the future, but I'm not going to bet the house on it. I am sort of skeptical for the reasons I just mentioned. Either way, I'll slowly be putting money in, so at least I'm putting my money where my mouth is in a way. But again, not totally confident on this one, like I am with oil. LAC, so this company had some weird split in 2023. They split into an Argentinian focused company and a US company? I had no idea this would happen at the start of 2023, and lithium prices were suppressed in all of 2023. It seems the demand wasn't there for lithium, and in a recent video I was watching/listening to, it was mentioned that some people just didn't want EVs as much as everyone thought, despite all the government subsidies and whatnot. And most EV companies aren't profitable, except for Tesla. Of course, Tesla wasn't always profitable, so the other companies are playing catch-up. But apparently, the demand for EVs simply isn't as high as people once thought, which has contributed to the suppression of lithium prices. I'll slowly still buy into Lithium Americas Corp, as I still believe the demand for EVs will pick up in the future, but in the meantime, in the present moment, it seems the demand is suppressed, so maybe this demand suppression continues into 2024. Who knows? Recall these are longer term plays. They're not plays for 2024 exclusively, they're also for 2025 and beyond. My oil plays I likely won't hold forever. It's too early to tell what'll happen, but potentially the world starts needing less and less oil, and more renewable sources of energy will replace oil. So once that transition starts to occur, I'll sell out of oil. But at this stage, I foresee lithium being a more profitable trade in the longer term. In February, we will see some lithium companies report earnings, so we can get a gauge of lithium prices then, rather than just seeing the spot prices. I always thought they'd be basically the same, but this finance channel who's been in the whole stock market game for 15 plus years knows better than I do. And he has a good eye for commodities too. So we'll know how lithium is doing in February. Might make for a good buying opportunity. At the very least, we can see how lithium companies are doing. Now, whilst we are talking about electric vehicles, there are some stocks that relate to EV charging stations. Avoid these for the longer term. They do make for good swing trades, as these stocks usually spike way up when the market rises, and they drop way down when the market falls. So they're good swing trades to make, but at this stage, they're not a good long-term investment. Wall Street Millennial, one of my A-tier finance channels, went over this in a recent video, but the crux of it is, people can charge their cars from home. So why use an EV charging station? You can't really refuel with petrol at home. At least not as efficiently as you do with EVs. EVs take a while, so each charging station can only generate a set amount of revenue each. Even if they were being used 24/7, the time it takes for someone to charge their car leads to not a lot of revenue being generated per charging station, whereas petrol pumps can take 2 minutes to fully fill up, as opposed to the 20 to 30 minutes for an EV charging station. The EV charging stations also require a lot of admin staff, since the stations have heaps of issues, so despite having no employees for a charging station, they do need admin staff to take calls about them. Which also means, if there's issues with the EV charging stations, the charging station isn't producing any revenue. Meanwhile, gas stations only need 1 employee per station. No admin staff required. There's probably more to it, so check out that video if you want to know more, but the TLDR is, lithium companies may be a good idea, but EV charging stations are not at this point in time. I only touch those stocks for swing trading purposes. So now I will go over some stocks that aren't currently in my longer term portfolio, but chances are I will slowly start buying into them one day. GTBIF, a cannabis stock, but this company has better financials than CGC, as I mentioned earlier, so I may look at dollar cost averaging into this instead of CGC. HITI, literally the same reason as above, another cannabis stock with better financials than my prior choices. ALB, the largest producer of lithium for EVs in the world. If I lose faith in Lithium Americas Corp, ALB will be the backup play. They aren't purely lithium, but it is a big chunk of their operations. The company has had a worse 5-year performance than Lithium Americas, so take that for what you will, and obviously this doesn't mean ALB will continue to underperform Lithium Americas Corp. It's just yet another thing to keep in mind. There's always extra things to keep in mind with the stock market. Berkshire Hathaway, Class B shares obviously, no way can I afford Class A shares. Great company, solid fundamentals, and a good strategy. Charlie Munger has passed on now, but the company still sticks to its strategy, so another good longer term stock to keep in mind. IWM, Russell 2000 small caps. So to summarize a long thesis, a lot of the market rally in 2023 was carried by large cap companies, and from what I've seen, potentially the smaller cap stocks will catch up. At this stage, this is more so specifically a play for 2024, but depending on how 2024 goes, we may carry this trade further. Bitcoin, didn't buy any crypto in 2023, and look what I missed out on, lol. To be fair, there were other stocks that rallied hard, but having more crypto exposure would be nice. I'll slowly buy into this too. Once upon a time, I had a wider spread of cryptos. I may look at doing this again in the future, but I can't be putting too much money into the market. I do need a safety net of cash for my house, which is a much better investment. Well, here in Australia anyway. Check back in 5 years. I can assure you I won't regret buying a house. Plus, it's just some fun spreading your investments out. It's like the diversified grind, except in terms of the money/investor stats specifically. It's like, yeah, here are my long-term stocks. Here are some swing trades I'm making. Here are some cryptocurrencies I bought. This is my house and where it's located. Here is the location I'm looking at for my second property. I find that stuff to be fun. Just like life. Yeah, here's my career. Here's what I make between both jobs. Here's my current training and diet plan, here are my investments, this is my side hustle. So buying into crypto is not only likely a good move for the longer term, but it's also just some fun. So that's where I'm currently at for my longer term stock portfolio. If new data presents itself and tells me some of these are bad investments, I am subject to changing my mind. Additionally, I may also start buying into other stocks if I see other opportunities. Everyone has their own strategies and reasons for certain stock picks. There's no perfect strategy. Even the big dogs on Wall Street don't have flawless strategies. This is all part of the fun. Part of the investment game. Let's see how this goes. Thanks for watching. That is all.